We are seeing oil and gas prices jump. Earlier today, Brent crude was trading at a 4-year high of $126 a barrel.
Bank of Canada held interest rates steady in their decision this week, but warned the ongoing risk is already causing inflation, and it could get worse.
Canada is being buffeted by global events and geopolitical uncertainties.
$105 a barrel today after spiking to about $107 to start the day.
Canada is now facing a major energy shock, and the situation is hitting harder than expected because the government built its long-term economic strategy around the idea that natural resources would guarantee stability and protection. That belief ignored warning signs in the global market, delayed important planning decisions, and now the supply chain strain has exposed just how fragile the system really is.
It's still very, very high compared to before, and that is, of course, what's driving up the price of gasoline, jet fuel, all sorts of other things. And Canadians will have probably either noticed already today, noticed last night, or they will notice as today continues that gasoline prices are shooting up in this country again.
Anis, what are some of the reasons behind the ongoing increase?
So this surge really, which took that international standard oil price, Brent crude, to a 4-year high, is mostly, or at least significantly, because of these concerns over the conflict re-escalating near the Persian Gulf at the Strait of Hormuz between the U.S. and Iran. But
the scale of this global disruption is where things start to get serious. The Strait of Hormuz is disrupted, and suddenly around 11 million barrels per day are taken out of the global flow. That is not a slow adjustment or a manageable dip. That is supply vanishing almost instantly. At the same time, global inventories drop by about 500 million barrels, creating a huge gap in available supply. Cargo already in transit gets delayed or halted, ports slow down activity, and the market reacts fast.
There's really a lot of, we don't know what's happening next, and we don't know what's going to happen in the minds of commodities traders. And when they are unsure about something, typically that drives the price up.
Prices that were already around $105 to $107 per barrel spike sharply by another 57% in just 1 month. Across Asia, the pressure is already visible. Fuel use is being limited, work schedules are being reduced, and jet fuel is being tightly controlled to manage shortages.
There's also this sort of financial confusion happening, is maybe the way that I would put it, because the price that we're seeing, that we quote, this, Brent crude oil price, that's a futures price. That's what traders expect to pay at a certain point in the future for a barrel of oil. But the price that they need to pay for an actual physical barrel of oil is much higher, and the price that's projected across different months is also sometimes higher, sometimes lower. So
Meanwhile, Canada's response looks slow and disconnected from reality. Leadership is still talking about monitoring the situation, even as the effects are already fully in motion. But here's where Canada's own economic assumptions start to break down. For years, the idea was simple. Having large oil reserves meant security and stability. That narrative sounded strong, but it ignored a basic reality. Having resources does not guarantee affordability or access for everyday people. The economy itself is already weak, growing at only around 1%, barely moving forward. Now, under pressure from global energy shocks, it is drifting closer to recession territory.
I have to tell you, though, we just went through the largest trade crisis we had ever seen. Now we're piling on another so-called supply shock. The difficult answer here is when we see things we've never seen before, we don't know exactly how they're all going to pan out.
That is not resilience. That is an economy already strained, now pushed over the edge by external pressure. The gap between expectation and reality is becoming impossible to ignore. Canada has massive oil reserves, yet consumers are paying more and adjusting their daily behavior because energy costs are climbing too high. This is not just bad timing or luck. It reflects long-term economic decisions where infrastructure expansion slowed, major projects were delayed, and energy policy became more about political conflict than practical delivery.
Gas pumps are among the first places that global consumers are feeling the pinch. Motorists are especially hard hit by higher fuel prices. The increases vary from country to country with knock-on effects feeding through to the rest of the economy.
I didn't used to. I used to drive my kids to a lot of places. Now I can't afford that.
As global demand rises, Canada is not positioned to fully benefit from higher prices, which turns a potential advantage into a missed economic opportunity. The result becomes even clearer at the pump. Fuel prices are now shaping daily life for many households. Gas is averaging around $1.70 per liter nationwide, but in some regions it has already passed $2 per liter. Diesel is also rising above that level in several areas. On the West Coast, prices reach about $2.17 per liter, while on the East Coast they sit closer to $1.88. These are not small changes. These are price jumps that immediately change how people travel, spend, and plan their budgets. Families are not just reacting anymore, they are actively changing how they live their daily lives. They are driving less, skipping unnecessary trips, and constantly calculating whether a journey is worth the fuel cost.
Second, after more than a year with inflation close to the 2% target, higher global energy prices are pushing inflation up. The surge in gasoline prices, combined with still elevated food price inflation, is squeezing more Canadians.
These small decisions are not isolated. They feed straight into the wider economy. Because once fuel prices start moving like this, everything else moves with them. Transport costs rise almost immediately across the board. Trucking companies pay more for every kilometer they travel, and those added costs do not stay at the company level. They get passed on to retailers, then passed again to consumers. That means groceries become more expensive, everyday essentials cost more, and suddenly this energy shock turns into a household budget shock, hitting every bill that arrives at your door. And the official response from Ottawa:
how does an oil blockage halfway around the world in the Middle East affect the price of gas here in Canada so quickly? Like, almost none of the oil that tankers carry through this tiny little waterway that Iran has blocked even comes to Canada. The vast majority goes to Asia. And yet, gas prices here, up and up and up.
More statements about monitoring inflation and maintaining stability, but stability for who exactly? Because in everyday life, people are not feeling stability at all. They are feeling rising costs across everything. Now, the deeper issue becomes even clearer, and it's infrastructure. Canada simply does not have enough capacity to fully move or redirect oil during a supply squeeze. The pipeline system is already operating near its limits, leaving no real flexibility to respond to sudden demand spikes. The Trans Mountain expansion was finally completed after years of delays and political disputes, but even that is not enough on its own.
Until the war, we expected inflation to stay close to the 2% target. But sharply higher gasoline prices are now pushing up inflation.
You know, one major project after more than a decade of waiting still does not fix the core bottleneck. It shows how slow large-scale energy development moves in this system. Then there is the Pathways Project, a roughly $24 billion pipeline proposal still stuck in approvals and environmental review stages. While it remains delayed, global buyers are already securing long-term supply agreements elsewhere. They are not waiting for uncertainty. They are moving to suppliers that can deliver immediately. This means billions in potential economic value are being left on the table, not because the resources are missing, but because the infrastructure to deliver them is not ready. That creates a clear gap between what Canada has and what it can actually use.
Since our previous forecast in January, the war in the Middle East has sent global energy prices sharply higher, increased financial market volatility, and disrupted shipping for fertilizer and other commodities.
And this is where the situation becomes even more striking because Canada stands out among major economies. It is the only G7 country without a strategic oil reserve. That detail matters a lot in moments like this. Most major economies keep emergency stockpiles to soften supply shocks and stabilize markets during disruptions. Canada does not have that buffer, so when global supply tightens, there is no cushion to absorb the impact, no reserve to release, no backup system to slow down the price pressure. Other countries can delay the shock. Canada feels it immediately without protection. That is why when discussions turn to rebates or temporary relief measures, the key question becomes unavoidable.
We can't just turn it into diesel fuel for trucks and ships and trains. So it's fair to say that the U.S. is more insulated. It's fair to say that Canada is more insulated, but no country is an island in the global economy. And global trade matters for every economy.
Where is the actual supply coming from to support those promises? Because at the end of the day, money does not replace fuel. Announcements do not magically bring back missing supply. And without a proper reserve, every promise sounds weaker the moment it is spoken.
Growth looks to have resumed after contracting at the end of 2025. Consumer and government spending are contributing to growth, while U.S. tariffs and trade uncertainty are weighing on exports and business investment. The labor market is soft, with the unemployment rate remaining in the 6.5% to 7% range, reflecting both weak hiring and fewer job seekers.
Now add inflation into the mix, and the situation becomes much more stressful for decision makers. Inflation is already pushing past 3%, and that is before the full impact of higher oil prices has even fully spread through the economy. You already know the chain reaction from here. Energy costs rise, transportation becomes more expensive, production costs climb, and all of that feeds directly back into inflation again. This is not a complex mystery, it is a predictable cycle.
That this supply shock has dissipated and that inflation is definitively on its way back to the 2% target. Now, the Fed was always sort of in that situation that it needed to be able to say, look, we're on our way to the target to justify cutting, but the existence of a supply shock has pushed forward the date when it will be able to make that declaration.
The real issue is that there is no clean solution available right now. If interest rates are raised, housing takes the hit first, and the housing market is already under serious pressure. If spending slows too much, businesses struggle, investment drops, and the economy risks sliding toward recession. But if rates stay the same and inflation continues rising, then the pressure keeps building anyway. That is the position the economy is stuck in right now. This is exactly why the central bank is in a difficult position.
In many parts of the country, that gas tax relief that we saw from the federal government, never mind, the tax isn't there, but the price you're paying at the pumps is either going to make up for that or will be more than it was, Arthi.
The supply shock limits how fast policy can respond. Inflation needs to come down, but the main driver, energy costs, is still active in the background. So the reality becomes simple but uncomfortable. Wait and watch. That means households absorb higher costs. Businesses deal with shrinking margins, and the economy slows down while everyone adjusts in real time. That is not a strong position. It is a constrained one. And the deeper problem is that this did not appear suddenly. Years of easy financial conditions and delayed adjustments built a system that is less able to absorb shocks. Now that pressure is here, the weaknesses are becoming visible in real time.
CPI inflation rose from 1.8% in February to 2.4% in March. Core inflation has been easing and held steady just above 2% in March. The proportion of the components of the CPI basket rising faster than 3% has also declined in recent months.
When you look at actual economic data instead of official messaging, the picture becomes even more serious. Canada saw a loss of about 84,000 jobs in a single month. That is not a small fluctuation. That is a major drop outside normal economic cycles. The explanation often points to global conditions. And while global pressure is real, it does not fully explain why domestic responses are so sharp. Businesses are facing a mix of higher energy costs, higher borrowing costs, and unpredictable demand at the same time.
We will also be closely monitoring inflation expectations. Near-term inflation expectations have moved up with higher gasoline prices and still elevated food price inflation. But longer-term inflation expectations remain anchored. Based on recent market expectations, oil prices are assumed to decline from an average of about $90 a barrel in the second quarter to about $75 a barrel by the middle of next year.
In that environment, companies react in the only way they can, cutting jobs, freezing hiring, and delaying expansion plans. Once job losses start, the impact spreads quickly. Fewer employed people means lower spending. Lower spending leads to weaker business revenue, and weaker revenue leads to even more job cuts. It becomes a feedback loop that reinforces itself. At the same time, households are under pressure from multiple directions. Fuel costs are rising. Food prices are climbing. Mortgage payments and borrowing costs remain high.
Because we've seen that spike at the pumps for people in North America, what do you expect from the Federal Reserve then next week?
We don't think the Federal Reserve is going anywhere next week or for the next couple of meetings. Now that this supply shock is in train, is on the way, we don't believe the FOMC will be able to cut rates until it has definitive evidence.
So the adjustment does not come from a single place. It shows up in everyday financial decisions. Savings start to shrink, credit card usage rises.
Economic problems around the world, the recessions. And today, only as of today, we lost 11 million barrels per day.
People begin relying on borrowing just to maintain basic spending levels. That kind of pattern is not stable. It is a gradual financial squeeze that builds over time.
This very clearly is the worst energy crisis of our lifetimes. We have lost over 11 million barrels per day of production.
And all of this is happening while official messaging still focuses on stability. And that's the situation for today on Yesterday Canada. If you want more updates like this, drop your thoughts in the comments and subscribe so you don't miss what happens next.